All right, welcome to the Explainer. We love to break down big, complex topics here. And today, we're diving headfirst into the world of international finance. We're going to talk about how all that money zipping across borders actually shapes, well, everything in the global economy.
So here's what's on the docket. We're going to start simple, with just trading goods. Then we'll get into the really cool part, how finance lets us trade across time. After that, we'll look at a few big puzzles that even economists argue about, figure out how we keep score of all this, and finally, we'll zoom out to see the big picture of today's global imbalances.
All right, let's kick things off with part one, trading goods across borders. This is a really fundamental idea, and honestly, it sets the stage for everything else we're going to talk about today.
So just imagine for a second, a country that's totally closed off from the rest of the world, a hermit kingdom, basically. In that kind of place, there's a really hard limit on what people can have, right? You can only consume what you produce. That's it. Full stop.
But is that really the end of the story? What happens when we throw open the borders? What changes when you let goods and services flow freely between countries?
Well, this is where we get what economists call intra-temporal trade. It's a fancy term, but the idea is super simple. It's the classic concept of trade, right? You sell the stuff you're really good at making, and you buy the stuff that other countries make better or cheaper. Simple as that.
And here's the key takeaway. The big so what? Trade absolutely shatters that old limit. Suddenly, a country can consume way more stuff, and a bigger variety of stuff, than it could ever produce on its own, all by just specializing in what it does best and trading with everyone else.
Okay, so that's trading goods. But now, let's take this to the next level. We're going to see how this basic idea builds into something way more powerful. The ability to trade not just across space, but across time.
This, right here, is the very heart of international finance. It's what we call intertemporal trade. So instead of trading apples for oranges, you're trading resources today for resources in the future. Think about it like a country getting a huge loan to build a factory, right? They're borrowing from their future prosperity to invest and grow today.
And this slide just lays it out so clearly. Look at the difference. In a financially closed country, investment is totally chained to how much that country saves. But in a financially open country, whoa, you can tap into a global pool of savings. It completely disconnects a country's ability to invest from how much it's earning right now. That's a game changer.
Okay, but this is where the simple story starts to get, well, a little messy. If all this is true, and capital can just flow freely to wherever it can be used best, then why do we see these really weird persistent puzzles in the global economy? Things that just don't seem to match the theory.
Okay, puzzle number one, the Feldstein-Horioka paradox. I mean, think about it. If money can go anywhere in the world to find the best project, why on earth do we see that a country's investment is still so tightly linked to its own savings? It shouldn't be, right? But it is.
Yeah, it's a total head-scratcher. What this paradox really suggests is that even in our super-connected world, capital isn't flowing as freely as the textbooks say it should. There's got to be some kind of invisible barrier, or maybe just a strong home bias, where people prefer to invest in what they know.
And that brings us to puzzle number two, the Lucas paradox. Now, basic economic theory tells us that money should be flooding from rich countries to poor countries. Why? Because that's where the growth potential and the return on investment should be the highest. Makes sense, right? But it just doesn't happen. Not on the scale you'd expect.
So what gives? Why isn't the money flowing? Well, it seems there's a whole wall of reasons. Investors get spooked by things like political risk or corruption, or maybe the country just doesn't have the skilled labor or the infrastructure, the roads and ports, to make a big project work. And sometimes it's just government policies that are actively standing in the way. And for our last puzzle, we look at the Eurozone. Now, the whole idea of the euro was to let capital flow freely, and it did. But here's the weird part. It didn't always go to the smartest places to build factories and create jobs. A lot of times, it just poured into things like housing bubbles in certain countries. So you got all this financial integration, but you didn't get that convergence everyone was hoping for, where the poorer countries would catch up to the richer ones.
So, okay, we've got trillions, literally trillions of dollars, euros, and yen flying around the globe every single day. The question is, how in the world does anyone keep score?
Well, the answer is this really important accounting framework called the balance of payments, or BOP for short. The easiest way to think about it is like a super detailed annual bank statement for an entire country. It tracks every single economic transaction its people and government have with the rest of the world.
And the whole system is built on one simple, beautiful rule: double-entry bookkeeping, just like in business accounting. Every transaction gets recorded twice, once as a plus and once as a minus. So, you buy a phone from another country for $200. That's a minus 200 on one side, but the money you paid for it, that counts as a plus 200 on the other side. So, in the end, it all has to balance out to zero. It's actually pretty neat. Now, all those pluses and minuses get sorted into three main buckets. You've got the current account. That's mostly for the day-to-day stuff, trading goods and services. Then there's the capital account, which is for more specialized things. And then the big one, the financial account. That's where we track all the investments, stocks, bonds, real estate. When you look at them all together, they tell a story. Is this country, on balance, a net lender to the world or a net borrower?
So what happens when those accounts don't balance out individually, year after year? Well, if a country is consistently buying more from the world than it sells, it's kind of like it's running up a tab. And when that happens for decades, this accumulation leads us to a much, much bigger story: the story of global imbalances. We track this long-term tab using something called net foreign assets, or NFA. This is basically the ultimate bottom line of a country's wealth position with the rest of the world. It tells you, plain and simple, is this country a net creditor, meaning it owns more foreign assets than foreigners own of its assets, or is it a net debtor?
And as you can see from this chart, over the last few decades, the gap between the big creditor nations and the big debtor nations has just exploded. We're not talking about small numbers here. These are massive multi-trillion-dollar imbalances that have built up over time. This is the whole global imbalances problem you hear about.
And this all leads us to the big, multi-trillion-dollar question, especially when you remember those paradoxes we talked about, the ones that show money doesn't always flow rationally. Can this system, with these enormous lenders and enormous borrowers, just keep going like this forever? Are these global imbalances actually sustainable? Or are we heading for some kind of major, painful correction down the road? That's the question that keeps economists and policymakers up at night.